Welcome back to Intelligent Investment Today, the podcast that examines the timeless art of value investing, as laid down by the father of the craft, and the teacher and mentor to Warren Buffett no less, the legendary Benjamin Graham. In each episode we take a close look at one of Graham's many enduring principles, exploring how these foundational ideas translate in today's increasingly complex and fast-moving investment landscape. In this edition, we return to what is arguably one of the most important tenets of value investing, a concept we've touched upon many times before, and will almost certainly revisit many times again. Why? Because it lies at the very core of everything we do. It is the lens through which we understand market behaviour, investor psychology, and the opportunities that arise from them. Today we're talking about the central importance of Mr. Market. So let's get right on with it. As ever, sit back, strap in, and get ready for another lesson in value investing, inspired, as always, by the wisdom of Benjamin Graham. For listeners who are new to the podcast, or perhaps unfamiliar with the idea of Mr. Market, today's episode should be a real treat, and for regular listeners, a timely reminder. The concept of Mr. Market explains in a single, elegant metaphor why value investing works, and crucially, why it will continue to work as long as human beings are the ones making financial decisions. As we all know, humans are emotional, impulsive, easily distracted, and frequently irrational. Markets, which are nothing more than vast collections of human beings, inherit these very same traits. Graham's Mr. Market exists to help us understand exactly this, that markets behave the way that people behave, often wildly, unhelpfully, and unpredictably. In Graham's analogy, Mr. Market is imagined as your business partner in some private enterprise. But this is no ordinary partner. According to Graham, Mr. Market suffers from what he described at the time as manic depressive tendencies, what we would now call bipolar disorder. And anyone who knows someone with this condition will be very familiar with the extreme emotional swings involved. At one moment, the sufferer may feel intensely optimistic, euphoric even. At another, they may feel hopeless, dejected, and consumed by self-doubt. Rarely do they stay at a stable middle ground. So while we can certainly sympathise with Mr. Market's plight, it is indeed a difficult condition. You would be forgiven for thinking he's not the sort of individual you'd want to team up with in business. After all, reliable decision-making isn't exactly his strong suit. But before you write him off entirely, Graham asks us to consider one very attractive aspect of Mr. Market's character. He is unfailingly accommodating. Every single day, without exception, he presents you with an offer. He will either buy your stake in the business or sell you more shares. Your choice. And the price he offers is based entirely on how he happens to feel that particular day. If he's in one of his euphoric, excitable moods, he may offer to buy your shares at an outrageously inflated price. If he happens to be in one of his pessimistic spells, convinced the world is falling apart, he may insist on selling you his shares at a deeply discounted and undeservedly low price. His offers swing wildly from high to low, rarely reflecting the actual underlying value of the business. The key point Graham makes is this: Mr. Market's mood is not your problem, unless you allow it to be. Most of the time, the sensible choice is simply to ignore him. He won't take it personally, and he will be back again tomorrow with yet another offer, just as emotional and just as inconsistent as before. But just occasionally, when his mood swings to one extreme or the other, opportunity knocks. When he's feeling especially low, and his selling price is far below what you know the business to be worth, you may choose to buy. When he's feeling euphoric and offers you far more than the business is reasonably valued at, you may choose to sell. In this way, you profit not from predicting the future, nor from following trends, but from the inevitable mood swings of your highly emotional partner. Of course, Mr. Market is not real. He is, as Graham intended, a metaphor, an allegory for the behaviour of the stock market as a whole. The daily fluctuations in stock prices, sometimes subtle and sometimes dramatic, mirror the emotional states of the millions of individuals participating in the markets. When the collective mood is depressed, stock prices fall far below their true worth. When the crowd becomes euphoric, prices can soar to unjustifiable levels. In both extremes, value investors stand ready to take advantage. You may have heard the argument that because millions of people are buying and selling stocks daily, the prices generated must therefore be efficient, accurately reflecting all the available information, expertise, and analysis. This is the foundation of what is known as the efficient markets hypothesis. But as Graham and countless real-world examples show, this theory falls apart under scrutiny. Why? Because it assumes that the average investor is analytical, informed, emotionally stable, and consistently rational. In reality, the typical investor is none of these things. Most rely heavily on gut feelings, follow the crowd, react impulsively to headlines, and often make decisions that are based on fear, greed, or social pressure. In other words, the stock market behaves much more like Mr. Market, moody, erratic, and frequently irrational, than like a perfectly calibrated machine. Prices often rise because people see other people buying and assume there must be a good reason. They fall because people see others selling and panic. It becomes a self-reinforcing loop, a mass exercise in emotionally driven, committee-style decision-making. So, how well has the concept of Mr. Market stood the test of time? In truth, it may be more relevant today than ever before. For one, the overall standard of investor knowledge has arguably declined. In Graham's day, investing was largely the domain of wealthy business people. Individuals who either had financial expertise themselves or the means to seek professional advice. Buying or selling shares required phoning your stockbroker, who might also provide informed commentary. The process was slow and by its very nature, somewhat exclusive. Today, trading is not only easy, it's instant. Anyone with a smartphone and a few dollars to spare can be an investor. On one level, this is great. Investing has become democratized. But on another level, it means the market is now crowded with individuals who may have little or no financial training, no investment framework, and in many cases, no patience at all. The butcher, the baker, and the candlestick maker now stand shoulder to shoulder with seasoned professionals in the marketplace. The result is a far more emotionally reactive environment. The second reason Mr. Market's relevance has grown lies in the sheer flood of information available. At first glance, an abundance of information sounds like it might be beneficial. In theory, more information should lead to better decision making. In practice, though, much of what passes as financial information today is nothing more than noise. Spend 5 minutes on a Reddit stock forum and you'll see exactly what I mean. People with no background in business, no training in finance, and no understanding of market fundamentals have been given a global megaphone. They offer bold predictions, sweeping statements, and wild speculation, all stated with astonishing confidence. And millions of people listen. The GameStop saga was the most famous example of where this leads. A struggling video game retailer became the centre of an online buying frenzy, driven largely by enthusiasm and memes rather than business fundamentals. The price surged by more than 1,000% in just 2 weeks, defying both logic and common sense. And as we now know, the price eventually returned to earth just as quickly. But GameStop was not an anomaly. It was merely the most spectacular illustration of what happens when disinformation, speculation, and crowd psychology collide. This kind of behaviour happens daily on a smaller scale across countless stocks. The written word, regardless of merit, often carries more weight than it deserves. So where does this leave the value investor? Value investors are, in many ways, the complete opposite of Mr. Market. They work hard to prevent emotion from clouding their judgment. Their decisions are grounded not in gut instinct or crowd sentiment, but in careful analysis of what a business is actually worth. Its assets, earnings, cash flows, and long-term prospects. They resist the urge to panic when prices fall, and the temptation to celebrate too quickly when prices rise. They remain patient, rational, and consistent. Yet, if value investing has such a strong track record, why doesn't everyone follow it? The answer, as Graham often said, lies in temperament. Almost anyone can learn to read a balance sheet or calculate intrinsic value, but not everyone has the emotional discipline required to stay rational when the market is anything but. It is extremely difficult to remain calm when others around you are panicking, and to resist joining the crowd when the market is soaring. For many people, this is simply not in their nature. Value investing requires a rare combination of analytical skill and emotional stability. Without both, the strategy falls apart. To conclude, Mr. Market remains an essential metaphor for understanding the irrational behaviour of stock prices. Investors who base their decisions on his daily mood swings are likely to be disappointed. Those who focus instead on the underlying fundamentals of the businesses they invest in stand a far better chance of long-term success. Ignore the noise, ignore the drama, and ignore Mr. Market, except of course when his emotional swings create opportunities. Thank you for tuning in to this episode of Intelligent Investment Today. I hope that you've enjoyed what is a timely reminder of the importance of the idea of Mr. Market to all we do as investors. If you have, please do consider subscribing or adding to playlist so that you need not have any excuses to miss future editions. And of course, please help spread the word, and let's continue to grow this community together. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.